Because capital decisions typically involve a longer period of time, we will need to factor the time value of money into those decisions. We will just provide a very brief review of the concept of the time value of money here. If you would like a deeper dive, please access our Using the Time Value of Money to Make Financial Decisions course here on lynda.com. Now, like other commodities, money has value because it's a scarce resource. Therefore, a payment called interest is generally required for its use. Because the time value of money is widely recognized, few people would consider hiding money under a mattress or otherwise keeping large amounts of idle cash. They realize that there is a significant opportunity cost in doing so. Money left idle will not earn interest from a bank, nor will it earn the potentially higher returns that can be obtained from investments in corporate stocks and bonds or real estate, for example. Because money has value over time, the timing of expected cash flows is important in investment decisions. This is the essence of capital budgeting, comparing the cost of an investment with the expected future net cash inflows to decide whether, given the risks and available alternatives, the project should be undertaken. An investment made today will not generate cash inflows until the future, either periodically over a number of years or in a lump sum several years hence. Thus, for the comparison of cash flows to be accurate, all amounts should be stated at their value at one point in time, generally the present. This means that all future cash flows should be stated in terms of their present value. The mathematical process of adjusting future cash flows to their present values is called discounting. The choice of the correct interest rate or discount rate to use in doing time value of money computations is extremely important. In fact, this is one of the topics emphasized in the field of finance. Generally speaking, managers use relatively high discount rates when evaluating projects or investments that involve a high degree of risk. An expectation of a high rate of return is necessary to entice a rational manager into undertaking a very risky project. In addition, a manager must consider what it will cost to obtain the funds to finance the project. Now, because of the time value of money, a difference in the timing of cash flows can make one investment more attractive than another, even if both involve the same total amount of money. To illustrate, assume that Project A will produce $100,000 at the end of 1 year, and that Project B will return $50,000 at the end of each year for 2 years. Both projects will generate a total return of $100,000. However, by using present value computations and assuming a discount or interest rate of 10% per year, the discounted cash flows from Project A are $90,910 and from Project B are $86,775. In other words, if the appropriate discount rate is 10%, receiving $90,910 right now is the same as receiving $100,000 1 year from now. Similarly, receiving $86,775 right now is the same as receiving $50,000 at the end of each year for the next 2 years. The difference in the present values of these two projects with the same total cash flows arises because with Project A, the cash is received sooner. Cash received sooner is worth more because it can be put to productive use. Cash received sooner has a higher present value. That is the essence of the time value of money. As this analysis shows, discounted cash flows reflect the time value of money and should be considered in capital budgeting. For short-term investments, this approach does not significantly affect the results. Ignoring the time value of money can be misleading, however, when evaluating long-term projects. Now, the determination of net income in accordance with GAAP is based on accrual concepts that recognize income when it's earned, not when cash is actually received. Thus, accounting net income doesn't necessarily coincide with cash flows. In capital budgeting, the focus is on cash flows. Why? Because the computations are based on the returns that can be earned on alternative investments. To be able to do these computations, you need a solid understanding of how to measure cash inflows and cash outflows. Cash outflows include the initial cost of an investment plus any other expected future cash outflows associated with the investment. The mechanics of the actual computation of the present values is left to our other course. Suffice it to say that money to be paid in the future has a lower value today in present value terms. Cash inflows include all current and expected future revenues or savings directly associated with an investment. Less obvious cash inflows are cash savings that occur when an investment reduces future costs. In brief, the present value of all cash that is likely to be received or saved as a result of an investment should be included as a cash inflow. While the details of the computations can get complicated, just recognize that money paid or received in the future must be discounted to a value in today's dollars if you want to incorporate into your analysis the time value of money.